This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Thank you for joining us today on this edition of the Alternative Investing Advantage podcast. My name is Alex Perny. Today on the download, markets are set for a relatively positive week. We've had a lot of good positive movement with all of the indexes trending upward on the continued strong push by the earnings season that is well underway. Now we have kind of an interesting week this week. We have the US IPO market bracing for a 13-deal week. So we have 13 different companies that are premiering on the New York Stock Exchange. Interesting about them is that we don't see that any of them will probably break $1,000 of market cap valuation. But if you are interested in investing in emerging markets, definitely something to watch with 13 different flavors to choose from when it comes to buying into new emerging companies. So keep that in mind if you are looking to invest in new companies. You got 13 different ones to choose from. The chemical giant DuPont stock actually dropping after a strong earnings report, but that comes on the tails of a $5.2 billion Roger buyout deal. Now the stock is overall up, looking at a trading of about 2.5% up, but we have seen some significant dips in that. We also have pharmaceutical giant Pfizer reaching guidance on COVID vaccine sales and a $36 billion deal to produce more vaccinations. So great push on that effort and a strong potential to make some money if you are looking at investing in biotech during this very intense development cycle for these types of companies. Rental car giant Hertz, the deal is not signed quite yet with Tesla. However, Tesla stock is still rallying. The rental car giant still looking to purchase a large tranche of electric vehicles to inject into their fleet, and Tesla stock also remaining high on some of the more interesting and provocative tweets of their CEO and founder, Elon Musk. So certainly something to watch for if you are looking for some good growth within that market as well. Now, we do have U.S. stock futures looking at a little bit of a pause as the record highs that they've been trading on as the Fed has started their two-day meetings this week on Tuesday and Wednesday. Now, the first day of November has seen the Dow Jones Industrial Average Composite Index go up 0.26% and rise 95 points. The S&P 500 increasing 8 points or 0.18%, and the NASDAQ composite trading up 0.63% and gaining 98 points in total so far this week. All three indexes notched record highs, with the S&P 500 now up 23% in 2021. Now, the Fed is talking about cutting their bond purchasing program even further, which was a holdout of the COVID-19 relief efforts that were passed into law earlier this year and late last year. So it's certainly something to continue to watch as to see how some of these market stimulus packages start to be phased out and how the markets kind of settle into their own. However, we are still seeing some bad supply chain issues, but the markets are tending to believe that those are going to alleviate some. So the futures are certainly trading a little bit higher. Now, looking at that, we certainly do have some stuff looking into next week after all of these IPOs or earnings come out. So it certainly will be interesting to watch and see where the futures of these markets are going to be trending when we come in next week for the download, as well as if we have any updates from the Fed on their meetings after they complete this week, and to see how the supply chains are going to be affected going into the holiday season. This has been the download. Today on the What Is? Derivatives. What is a derivative? The term derivative refers to a type of financial contract whose value is dependent on the underlying asset group or benchmark, potentially. A derivative is set between two or more parties that trade on an exchange on the over-the-counter markets. These contracts can be used to trade a number of assets or carry their own risks, and the prices for derivatives from the fluctuations of the underlying asset. These financial securities are commonly used to access certain markets and may be traded to hedge against risk. Derivatives can be traded or exchanged on the over-the-counter markets, but people need to understand that these can be significantly riskier types of trading vessels and need to use caution accordingly. This has been The Download.
All right, everyone. Thank you for joining us for another edition of the Alternative Investing Advantage podcast. Today, we are happy to have Park Capital Partners LLC with Bill Zahller and Richard Coyne on the call with us today. Thank you very much both for being with us.
Thanks, Alex. Appreciate it.
Yeah, thank you, Alex. Glad to be here.
Fantastic. Well, I always like to kind of start this off, with a general just background. So maybe give me the 30,000-foot view of, both your professional careers up to here, and give me a little bit of background on what Park Capital Partners is, and we'll kind of get into what you got going on and some of your strategies associated with it.
Sure. Bill, why don't you go first?
Yeah, well, my name is Bill Zahller, and we started Park Capital Partners. Richard and I back in, joined forces about 2017. Before that, we each had our own individual companies that invested in our first deal together. But as far as background, after college, I went into aviation, flown professionally for 20 some years all around the world. It was kind of a unique background as far as you get to see a lot of things, similarities all over the world, and things that I guess it's been kind of influential to my investing strategy. But that's kind of the background that I came from, and then got into real estate probably 2003. Did a lot of single family investing, and then, as Richard will attest to, you start doing the math, and it's your income off one-offs. It takes a lot of units, and you realize you need to scale. So did that for several years, learned a lot from it. But then when I moved here to Asheville the second time, probably in 2016, started up Park Capital Properties, and like I said, joined forces with Richard the next year for his JC Lane company. And we started Park Capital Partners at that point, and have been solely focused on multifamily from that point forward.
Awesome.
Yeah, and my story is a little different than Bill's in the fact that I'm a little bit less in terms of the number of years. But so I've been doing real estate now for about 6 years. I've since retired from my W-2. My W-2 world was I ran professional services and was responsible for the selling for a large region and whatnot over my career. I started way back and earlier in doing IT consulting, and I was always more on the business side, really on the management side, not really a heavy techie person. So I graduated and kind of moved into follow that management track, and eventually began running large programs, and then eventually I moved over to the sales side, running the region, being responsible for the P&L.
Awesome.
But late in my career, just real quick, late in my career, I kind of realized, I hadn't really planned for the future. I had really, spent a lot of my time and focus in my, 30s and 40s, taking care of my kids, family, wife, getting the kids through private school, getting them into college. And then I realized, wow, I got to do something for myself. So I started looking around, and I just decided, I made the decision to go toward real estate. Tax advantages, just fantastic, things like that, as well as the opportunity to build wealth. And again, like Bill said, we teamed up after kind of doing our own thing for a little bit, and we've been able to pull down a number of properties. So it's been great working together, and super excited about the future.
Awesome. So we have a lot of different multifamily investment syndicators and companies on here, and I always try to take a little bit of a different approach with each one. It's easy enough for me to ask each one, say, hi, who are XYZ investment company? But, kind of the flavor I want to take with this, and we'll certainly get into what you maybe have going on here in a little bit. But, when you come together, you and Bill come together and you say, hey, let's do Park Capital Partners. What's kind of, the focus of the beginning of that, were you saying, hey, there's an apartment complex right there, and how has that evolved? Or have you did you get it right on the first try, or did you kind of have to evolve a little bit with, what you were identifying when it comes to looking at the commercial multifamily space?
Yeah, I'll take a shot at that first. I would say that we, in a way, we did get it right on the first one, but it took a while to get to that first one. Like Bill mentioned, he had done single family in the past. my first foray into real estate investing was really, I thought I was going to go down to single family, buy and hold. And then like Bill said, $100 passive income at a time, that takes a long time to replace my income. So as we both Bill was driving toward apartments, I independently started realizing, wow, I got to go toward apartments. I got to go bigger, faster. And then we, by teaming up, we realized, we have similar goals, similar objectives, similar values. And, that is to do right by our investors, protect their capital, grow their capital, and then improve the properties that we are a part of, we acquire. These are people's homes. We want to really do a good job with that. So it took us a while to get to that first one, a lot of networking, building relationships, finding, property management, brokers, different cities, touring, spending, grinding it out, really trying to drive toward that first acquisition. And our first acquisition was a 216 unit.
Awesome. Where was that located?
It was in Atlanta. It was I would characterize it as a C property. And we've since sold it and it did extremely well for the investors. And I guess the lesson learned there is that we don't buy C properties anymore.
So what maybe kind of getting into that, because I think that'd be great for people, especially for, maybe someone looking to start a syndication or get into this, just to kind of, even if people aren't familiar, people classify properties A, B, C, D, E, F, it kind of goes, A's are the top of the line, brand new, nothing wrong, turnkey. Most expensive, B needs a little bit of work, right. C, depending on location, D, F, there's always going to be an investor out there for a certain flavor of property. But what were some of the things that you kind of learned from maybe targeting that C property? And what were some of the things that maybe made it a C that you would maybe caution people, getting into this, that might be an issue, or people that are maybe looking to invest with a company that targets C's, some things to maybe do some due diligence on, with regard to that? What were some lessons you learned from that first property?
Yeah, absolutely. And it's all, make sure the key point I would say is to make sure the investors in the project have an alignment of interest, because there's money for every project. You just have to make sure they're aligned. Like I said, it goes from, core properties, the A plus, and there's even subcategories of that, right? The downtown central business district A property is a different animal than the suburban A property. There'd be, $1,000 plus delta in rents on those, even though they're both brand new A properties. So we look in the suburban, we don't look into the city centers. And what we realize, I think, from the C property is it's much more management intensive. That's the main. You're going to have more bad debt. You're going to have more turnover, more evictions, skips, all that. So it's much higher in that regard. And then on the value add plan, like Richard said, we make the communities better, we improve them, but that also involves as we spend $7,000 to $10,000 per unit to make it a better property, you'll hit some resistance potentially in what the tenant base can pay, the residents can pay. So you have to balance that a little bit more. You can't go into C-class working force housing. They're looking for a nice, clean, affordable place to live, right? They're not looking for granite and sub-zero refrigerators and all that. So, people have to be careful not to over-improve it. Look at your demographic as far as the income level in the 1, 3, 5 mile radius. Make sure that's up to where the rents will be. You're not stressing them out of being over 33% of their income for the rent payment. So our latest one, I think we were at, was it like a 16%, I think, Richard, and 18% for the renovated unit. So there's a large delta. We can still improve, still make it a much nicer unit and not hit any natural resistance on that. So I think management's the main difference in that. It's more intensive. You get more up to, and a good point, case in point is what just happened here with coronavirus. Remember, everybody locked down for the first, few months of it. And if you had a B class, B plus properties, a lot more, white collar office workers in that segment, so they can work from home, right? It's not that big of a transition. If you're truly workforce housing and you have to physically show up to do your job, that's more of an impact that way also. So you mitigate a little bit more risk, I think, having more of a blend of employer employment base.
Sure. Now, Alex, yeah. Sorry, just to add on to that real quick, again, so there's nothing wrong with C properties. I think it's just a function of risk and reward. Mm-hmm. The C properties carry higher risk. The reward may be a little bit greater, but again, there's some people, like Bill said, there's a deal for everybody. If you have the appetite for high risk, then great. And honestly, you mentioned class D, and we call that runaway. We don't want to do runaway deals that are in D properties. And there are properties that are 50% occupied, 0% occupied, and again, there's somebody for that deal, but it's probably not us.
Yeah,
and
you have not only the tenants running away from those properties, but also the investors as well.
Right.
Yeah. So, you kind of got your foot in the door with that C property. There's obviously a lot of learning and stuff. So where have you kind of grown from there? I believe you said you started, it was 2017 was correct?
Mhm.
Is when Park Capital Partners started. So over the past 4 years, you got your foot in the door. Where have you grown from there? Maybe not necessarily as a metric of just, okay, we have X number of revenue, we have X number of assets under administration, but where are the big growth factors that you have seen professionally and what you have started to do that have helped improve the investing platform that you now run?
Yeah, so maybe I'll talk about current, and then Bill could talk about the sort of what's next and that type of thing. But since that first acquisition, we've done a number of other acquisitions, and we've been involved in over 1,350 units. We've done over $100 billion in real estate transactions, and we've acquired a number of other properties. We look generally in the Southeast. We've acquired some other properties in Atlanta Metro. As well as Greenville, South Carolina area, and we have some investments in Texas, et cetera. And what we have been able to do over that time is, again, return to investors' capital. We've gone round trip on 3 deals where round trip means buy and sell. So your projections become a reality based upon how the deal turned out. And we're very proud to say that we've been able to do between 4% and 7% higher than projections for the investors on the 3 deals we've sold. And that's we're very proud of that. Our investors have been very happy with those returns, and obviously there certainly some tax advantage potentials along the way. So that's great. We're hunting for other deals. We're constantly on the lookout. We're constantly active in bidding. That's what it is. It's all about is to, really, look for that next deal, and again, help those investors, earn money and earn returns on their investments. So we're hunting and looking. Yeah.
Now so go ahead, Bill.
Well, I was going to say, and if you were asking the next step on the future, where the company's headed, we've actually this week just launched our value add fund. So we're taking out the Park Capital Value Add Fund starting this week. So that'll offer, what we see as the advantage to that is it offers instant diversification. You're in the fund, you're not just in one property, and also geographic diversity, as far as if one property is in Charlotte, one's Atlanta, one's in Raleigh, Durham, you have, if there's a local microeconomic issue, it doesn't spread across the entire portfolio. So that we're excited about that, and talking to investors about that going forward too, and kind of the new direction for the company.
Awesome. Yeah. And we'll get into that in a second, but something kind of popped up that I think might be interesting to dig into a little bit deeper. So you've had 3 deals go full circle, acquire, improve, rent, sell. What would you say are 3 consistent factors that you've seen across those 3 properties that you're like, okay, great, this is, work the same? And what has been kind of the 3 maybe big things that have been really different or maybe surprising between those 3 deals that you've had come through your desk since you've established Park Capital Partners?
So I think the things that have been similar are that, we've been able to buy right, and we've been able to achieve a lot of value by investing in those properties. The first property, we put $1 million CapEx into that property, and that was very pleasant and very surprising to the residents. We had a number of residents that said, I had already turned in my notice to vacate. I was going to move out, but wow, I see you guys actually are doing something here. You're actually improving the property. I appreciate that. Thank you. I want to stay. That was the C property. The B properties that, we've had just a positive experience in terms of investors recognizing that we're investing in the property to make their home a better place as well. So, certainly similarities there. I don't know, dissimilarities, maybe I think point back to what Bill said earlier, and that is that the B properties, you have more white collar workers that are able to work remotely, certainly during this pandemic we've been through. And it's, I guess in a way it's not quite over fully, but, certainly, we've been able to stay on top of keep the bad debt to a minimum, and the collections have been very strong across the board. So that's a similar, it did something, anyway. Go ahead, Bill. Yeah.
No, I was going to say, and I think what you touched on there, Richard, too, is a key thing to our company, and I think critical to anybody listening to this, if they're doing similar things, is communication with the residents. As Richard, mentioned, we stayed in constant contact them through. We were, we'd find ways to help them with rent, local assistant programs, whatever it was, if they weren't able to go to work. So we've had, very good collections, all things considered. We weren't very far off our projections, before the pandemic. So, I mean, it's been very good, but all that leads back to management communication. We've worked with them, we set up plans, and we've had very good success with that. So I just want to highlight that, or emphasize the fact that we communicate not overly, but we want to be very communicative with our residents and also with our investors. No one wants to be left in the dark, and the more you know about what's happening, the more you can adjust to it.
Absolutely. And what I think might kind of lead into performance, and correct me if I'm wrong on this, is that, let's say you bought a property and it has good rent rolls, you have very low defaults, you don't have many people, you have good occupancy in the property. The idea is basically, to try to keep those good tenants in there, and then to, continually keep them in there. So obviously you continue to get rents. Now, when it comes to doing improvements, obviously that's a cost factor, and, rents might have to rise a little bit, but, is there kind of a sweet spot between, trying to keep, if you get a property that's, almost fully rented out versus, what improvements you're trying to make and a goal you're trying to make with the property? And, is it kind of like hiring employees? It's much easier to, to train someone existing versus getting someone new in there, or, what is ultimately the goal with that? Is it the goal to keep and improve their experience, or to try to get, new people in, or does it kind of depend property to property that you're looking at?
Yeah, I would say it depends property to property, but to your point, if they're good residents, we want to keep them, but we just want to make the property better for them. And like, I'll use an example of our first property. When we went in there, the property next door to us that we shared actually a border with on the east side there, their rents were $200 to $400 higher for their renovated units. So when we go in, that we have the plan, when we go in, we don't go in and then see if we want to renovate. That's the value add strategy is our plan we use. So when we went in, we knew we had plenty of room to raise the rents $100 to $125 and still be cheaper than the competitor right next door. So we want to make it a better place, but still we don't want to be the top of the stack. We don't want to set the high water mark. So we're still a relative value add proposition to anybody looking in that area. They can have a renovated unit for us for cheaper than they can have for the neighbor. But small things like that, just $100 rent increase for the improved property. You take that over the 216 units times 12 months, divide that back out. In that case, like I said, the C-class property, already 6.5 cap rate, that's around $4 million in equity you created by that. I mean, so there little things on the front end have big equity multipliers on the back end.
Yeah, fantastic.
Yeah.
Sorry, go ahead.
I was just going to add, and again, like Bill said, a great tenant, you want to hang on to that person, but at the same point in time, if their rent is $200 under market, you got to fix that. It doesn't mean a $200 bump on the renewal, but you got to close the gap and increase that. It's our responsibility as operators to, make sure we're, optimizing the net operating income for the investors to make sure that they're earning the right return. Natural vacancy will happen, and that's how we turn units, and that's how we renovate units. And then, certainly, again, there are going to be some folks, whether it's an A property or a C property that, don't pay their bills and are going to wind up being evicted. And again, that's a natural unit to target as a renovation, that type of thing.
Great. And before we get into a little bit more of the new stuff you're doing, like with the fund that you mentioned, something that you had said a few times that I haven't heard other multifamily syndicators that I've interviewed say is staying away from bad debt. What does that mean to you? I mean, obviously, when someone hears bad, obviously you want to stay away from it. Debt obviously is something that is, almost always going to be associated with doing deals like this. You talk about, buying 10, 15, $20 million properties, it's not being taken down with cash. There's going to be some financing. So when you talk about bad debt, what does that mean to you? And when you say staying away from it, what are strategies, after we've identified what that is, what are strategies to stay away from it?
Well, so, again, it's a function of the type of property and how it's running. And again, when we look at the acquisition, when we're looking to acquire a property, we analyze and underwrite extensively and look at the books and look at the T12, the trailing 12-month income statement for that property. And we look to see what the bad debt is. There are some industry standards, industry norms for the type of property and generally for, what you pretty much should expect. And if we see a bad, and again, hopefully that's generally, based on the property type, generally 1% or less. If we see a bad debt run at 5%, well, why? Well, maybe it's because we're coming out of COVID and, all of a sudden now evictions that couldn't happen for the past 18 months are now taking place. Well, we understand that, but at the same point in time, we still have to, the loan is still going to be based upon the actuals. So we got to balance that. A property that has, an 8% bad debt, it may not underwrite properly to be able to win that deal, to go after that deal. So that might be a case where we just stay away from that bad debt. And certainly when we're operating the property and running the property, as Bill said, we make sure we're on top of the residents. The moratorium's over, and a lease is a contract. We have obligations as owners, and the resident has an obligation as a resident to pay their bills. And if they don't, there are consequences, and that's eviction. We certainly don't want to evict people, but again, if somebody's not going to honor their contractual obligation, then we have a duty to our investors to protect the net operating income of that property, and that means eviction. So again, we communicate really heavily with the resident to make sure that they've got a plan. And if they're not the evictions that have taken place recently have been because a resident didn't communicate with us, didn't do any effort, or didn't lift a finger to try to help solve the situation. We've been able to, since in the past 5 months, we've been able to achieve through our property management's efforts and cooperating with our residents, we've been able to achieve $75,000 worth of assistance. And otherwise that would have been bad debt. But by working with the residents and, and again, with the way the paperwork situation is, the resident has to cooperate to get that, the rental assistance. And if they don't cooperate, they don't communicate, well, I'm sorry.
Absolutely. And
just to clarify, I was just clarify, Alex, on the bad debt, that not to be confused with senior debt. Senior debt's the agency debt we go out and put on the property. The bad debt is what you're saying is just basically between the gross income minus what the tenant should have paid that didn't pay. So it's uncollected rent basically is the bad debt. And that, so make sure we're clear on the terminology on that.
Yeah, and thanks I was just about to point that out because, Richard, you gave a great answer. That was a graduate level answer for that one. So, it's definitely good to understand that, it's that kind of delta between, what your rent rolls should be in a perfect world and,
Right.
what the undercollected rents are. And, from a personal perspective, I've been involved in real estate investing for, almost 10 years now with regard to specifically what we do and been involved in multifamily for a long time. I try to explain that to people, especially in my generation. There's, the millennial generation of, it's not necessarily that, apartment management companies are, these big, evil corp places. It's in their financial best interest to keep people in there and rented. And if they're doing their jobs correctly, and obviously there's always going to be people that don't do a good job with this, to keep people in there, to help them get the assistance, to keep people being able to pay their bills so that way they can keep a roof over their head, a good roof over their head. Everyone wins. Someone has a house, someone's able to, stay in there. Some people are able to make money and make a living. The rising tide raises all ships. And if you have an apartment complex where you've evicted half the tenants and not lifted a finger to maybe try to help that, you're not making any money on that as well. So it's a good point. I think it's really great that you bring that up, and especially the fact that y'all try to help with that. I think that's very commendable to see that kind of happening in the industry, and almost every single real estate syndicator that we deal with has some type of program to that effect where they actively try to do that, because the little effort they put in on the front end to try to help out with that pays off in spades on the back end, especially if you try to sell the property out and you have a rent roll or a trailing 12 that is almost completely full. That makes the sale that much easier when you try to go for an exit.
Right.
Now to kind of transition, with the last part of this about the current stuff you kind of got going on. I know that was a little bit of the impetus for us trying to get in here, because you have a little bit something new going on with regard to not necessarily just maybe putting together a syndication, but putting together a fund. So tell me a little bit about the catalyst for that, what exactly that looks like and what exactly that means for your company and investors and the like.
Yeah, absolutely. And it's not new to us entirely. We've bought portfolios before of multiple deals, but this is just kind of, and like I said, what the advantage of as we see it is it adds instant diversification. You come into one deal, you're actually in all 3 to 4 deals would be what the fund is set up for at this point. We're going to have 3 to 4 properties in it, depending on the price of the properties. Of course, if it's 3 or 4. And it's going to be what we're looking at anyhow. So it's going to be in the Southeast, like I said, Charlotte, Atlanta, Raleigh, major city centers, Orlando, that have strong growth drivers. We'd want to invest in there on a single property basis. But the idea, again, we can pool it. And if you have one property that, returns 15%, 15%, one returns 12, one returns 18, it's going to blend out your risk a little bit better. You have, 4 properties performing, it's going to be pooled returns on that. So it have diversification, also risk mitigation by having multiple. And like I said, they'll be in different cities also. They won't all be concentrated. We don't believe in one city. So you have a little bit of geographical risk mitigation as well. So we think it's an advantage to the investors. It's and once you invest once, you can always go back, have another liquidity event. You can reinvest in the same fund and just buy more into that property while it's still open, while we're still taking acquisitions in that fund.
Sure. And what regs are these regulated under? Is it is it accredited investor only? Give us some nuts and bolts about it, because I think people are always interested to hear, how people are setting these things up, because we have other people, out there that might be listening to say, hey, I want to set something up like this. I got a couple of properties. I'd like to raise more capital. Give us maybe a little bit more of the technical side of things.
Yeah, absolutely. So it's under Reg D. It's 506C as in Charlie. So it's for accredited investors only in this fund. So, and again, we can go to the definition. Basically, the most common definition is $1 million net worth, excluding your primary residence. If you're single filing, $200,000 the last 2 years, expect to make that going forward. If you're married, it's $300,000. So if you meet those basic criteria, income, net worth requirements, either or, then you're a accredited investor. And on 506C, there's just one extra step, is it has to be third-party verified, either through a verification source, an attorney, a CPA. But there's just a form they sign for that. Once they're accredited and verified, they're welcome to invest into the fund.
And I would, sorry, go ahead, Bill or Richard. Sorry.
I was going to say, and of course, if you have a self-directed IRA, you can invest in these type of assets, assuming that you're an accredited investor. And we have a number of folks who have done that, and it's a great option.
Yeah, that's literally, I was going to say, I would not be doing my job on this podcast with Advanta if I didn't mention that. If you're accredited, if you're an accredited investor, your accreditation does extend to your retirement plan. So whether you have a Roth IRA, traditional IRA, solo 401ks, solo 401ks even have some other additional great tax benefits when it comes to investing in limited partnerships and 501s. If there's debt involved. So we're always happy to kind of go through that kind of thing and help people out, because if you can do these kind of investments when you don't even have to give a second thought to paying taxes on it, don't even have to worry about putting a K1 or anything on your personal 1040, it's just that much easier. People don't realize just how much easier life can be when you do some of this stuff through IRA tax shelters, as opposed, not that it's overly complicated to do it personally, and I'm sure you help facilitate that for your clients as well, but it is really kind of a cool synergy that we have with syndicators and helping people raise capital, because the part of this, obviously, you're trying to raise money for something like this, bring in investors to help bolster your position. And so many people just don't realize that that their IRA can be used for something like this. We just got some updated numbers, and there's almost a little bit north of 32 trillion. That's 4 commas and 12 zeros potentially on a number of retirement plan assets out there. So, if you're someone that's listening to this and you're maybe trying to put together a syndication or something like that, or you're looking to get invested in something like that, it's a big market to look at if you're looking for funds. They're out there, and the tax benefits are fantastic. So to circle back a little bit more with the fund that you're putting together, how long do these things normally run? I know they normally have kind of like a timeline with it. How do you determine how long you open this up for? Is there a certain amount of capital you're trying to raise? Is there a kind of a sunset on this of when these things close out?
Yeah, I'll handle the first, do the first part, Richard. If you want to take the second part, the first part on the timing duration of it, we're looking at a 5 to 7 year hold period. And the reason we have a window in there is it's not a closed-end fund as far as the date of disposition has to be December 31st, 2026, say. What we want to do is stay flexible, and that's our advantage of being, nimble, staying in the market, knowing the markets well, constantly talking to brokers, buyers, sellers, everything. So we have a good pulse of what's happening. So say December 31st, 2026 is a down cycle in the economy. We don't want to have to be forced to sell that just because it's date on our calendar and our PPM. We want to have the flexibility to maximize shareholder return and value on that. So we'll cash flow it through the period as it comes back, and it's a good time to sell. We'll sell it, year 6 then versus year 5. And inversely that, if it's an amazing time to sell it year 4, we've surpassed all our returns expectations, and we'll dispose of it at that point also. So we're going to maximize shareholder value as we kind of view the fund, but that's why we have the flexibility. But the planning is 5 to 7 years on the assets.
Okay.
Right, and the fund we're targeting is $30 million. That may increase, but again, initially it's targeting $30 million to, again, as we talked about, go out and acquire those 3 to 4 assets and in different areas, again, to build that diversification. So,
yeah, yeah, absolutely. And just to kind of make sure that people understand maybe the difference between, a fund and a generalized like syndicated limited partnership, is that this is going after kind of a pooled, again, a diversity play, as opposed to saying, hey, we're trying to take down this 300 unit, B-class apartment complex. We're going to do like a general partnership, sell limited partnership shares. This is more of a not necessarily attached to one thing, but more of an organic thing for identifying properties and assets and asset acquisition underneath of that cap of money that you're trying to raise, correct?
Right. So sorry, Bill. It's again, you're spreading the risk by having the asset, by having the investment, and you can invest more than once in the fund, of course, but by having the investment in you're spreading your risk automatically. When Bill mentioned we did a portfolio acquisition in the past, so when investors invested in that deal, they were automatically diversified into two assets. And we deliberately set that acquisition up with 2 separate purchase contracts so we could sell the assets separately if in fact it was needed. And we wound up selling them similar, but 2 different buyers within a week or whatever period that both deals closed. So the investors did great on that sale. But again, that's the concept. You're spreading risk across location, as Bill talked about, and whether you invest 1 time in the fund or whether you invest 10 times in the fund, your risk is automatically spread up right away.
Gotcha.
And one thing I just wanted to add, Alex, too, is it's not like a private equity true blind fund, right? We don't know, 123 Main Street is the property we're going to buy initially on that, or what the second or third one might be, but it's all going to be value add multifamily A and B properties. We're not going to buy a car wash in Washington State and, storage locker somewhere else. It's all what our specialty is in multifamily, and it's regionally in the Southeast. So it's markets we're experts in, and a product we specialize in. So it's not a true blind pool, but we have that kind of parameters on that.
No, understandable. And it's kind of cool to see how it seems very kind of an organic shift, if you will, of kind of going from that one property that you purchased and then maybe doing another syndication, some limited partnerships, and now having that experience and trying to add more value for clients. It's definitely something interesting that I haven't necessarily seen. I've obviously talked to other people that have had funds that they put together for multifamily or something, but it's been a very interesting conversation to see just kind of how the catalyst of all this and how it starts, and getting a little bit more of the technical aspects of it. I think people are really going to find that interesting. But again, we like to keep these things to right about 30 minutes. I think we're getting right about 35. So any parting thoughts? If people want to get in touch with y'all at Park Capital, let me know what else you have to say.
Alex, let me add one more thing in real
Sure.
quick. And again, I know we got to wrap. So,
but
very, very quickly, one thing that we also have done is we have created the Park Capital Partners Foundation. It's a nonprofit, and we did that. It's out and available now. And what we're going to do with that, and the reason we did it, is that we know that investors care about things besides just making money. They care about different causes. And so what's going to happen with the foundation is that when an investor invests with us, Park Capital Partners, Bill and I, are going to make a donation to honor that investor to an existing charity of their choice, one of 15 charities we've kind of handpicked. And we're also, Park Capital Partners is also fully funding the foundation. We're going to donate a portion of our profits to it, and we're also going to, of course, personally donate to the foundation. So our thought there is that, listen, you invest your money to make money, but at the same point in time, why not feel good about it? Maybe there's a particular cause you feel passionate about. So we'll donate to honor that investor to one of those causes.
Awesome. That's fantastic. We here at Advanta are very large supporters of Guardian Ad Litem for underrepresented youth in the legal system. That's a big cause that's near and dear to our heart. So I think that's wonderful that you do that. I think everyone should if you've never volunteered or you've never given charitably, give it a try. It's a fantastic feeling, and to know that you've done some good in the world, past just doing well for yourself is great. So again, thank you both very much for being on with us today. How can they find you? Park Capital Partners LLC is your website. Any other contact info you want to throw out there at the end of this?
Yes, they can contact us directly. Like you said, parkcapitalpartnersllc.com is the website. My email is bill@parkcapitalpartnersllc.
And my email is richard@parkcapitalpartnersllc.com.
All right. Well, thank you very much. This has been another edition of the Alternative Investing Advantage podcast. I hope everyone has a fantastic day and tune in next time. Thank you. Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.